Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. You know, we're here every Saturday and Sunday morning, and don't forget to tune into my live radio show every Sunday morning from 10 a.m. to noon throughout Florida. Visit our website, reznywealth.com, for, of course, times and availabilities of all of my programs. You know, we come here every weekend to really educate our listeners so you can make better investment decisions, and we hope that you ultimately make a better return on your money and you protect your capital from major catastrophic losses from recession. You know, I've been in the investment business for almost 30 years. I get a lot of questions all the time. You can always send those to Brian Rezny at reznywealth.com if you'd like, and I can always respond to those. But I get a lot of questions all the time. I could be at dinner sometimes, and somebody will walk up to me and say, "Hey, aren't you Brian Rezny on TV?" And I say, "Sure." And they'll ask me a question right there. So if you see me in public, tap me on their shoulder, ask a question. I always like helping investors get ahead in life. One of the things that I wanted to talk about today is really investments that you, the investor, need to avoid. Remember Wall Street? You know, Wall Street is one of the problems that we had in 2008. Wall Street got a lot of people into trouble in the recession of 2008 by selling you basically crummy products. And what I want to explain to you, the investor, today is investments that you need to avoid. And I'm going to give you some reasons why you want to avoid these investments. The reason often you want to avoid certain investments: high fees that ultimately take away your return. The higher the cost structure internally, the less money you make as the investor. So let's start off today, and let's talk about these investments to avoid. And remember, not all investments are made the same. And I know that the person that you might be working with has a rosy personality, or they work for a big bank or a big brokerage firm. That doesn't mean they work as a fiduciary, and it certainly doesn't mean they're going to sell you the best product under the suitability standard. More on that at my website at reznywealth.com. Annuities. Annuities, there's variable and these equity index hybrid annuities. Let me tell you what, one of the number one sold investments to seniors, retirees, pre-retirees are various annuities. Why is that? Are these things really good? I believe absolutely not. If you want to lose 30 to 40%, and I'm going to repeat that, if you want to lose 30 to 40% of your return, then go ahead and buy a variable annuity or one of these crummy equity index annuities. But you will lose 30 to 40% of your return. And you're asking, how, Brian? Expenses. I've reviewed literally hundreds of variable annuities in my career, and I've looked at a lot of these equity index hybrid annuities that these free dinner guys try and sell all the time to unsuspecting seniors. The internal cost structure on a lot of these products often run 3.5% to 4.5% every year. Annual expenses in a lot of these products. If you're basically making a 6% return on your money and your expenses are 3.5%, what do you get to keep? 2.5%. Most of it's going back to the insurance company or the brokerage firm. That's not good for you. Investors need to read the fine print. You cannot rely on the annuity salesperson to give you the real advice or the truth and the facts. They're not going to do it. The only person that cares about your money is you. And if you work with a salesperson of investment products like annuities, you are putting your retirement and your portfolio in harm's way. Annuities are expensive, and they rob your return between 30 and 40% of the net returns simply because of the high cost that they take away from your actual return every single year. So read the fine print before you sign on the dotted line, and never fall for a sales pitch, especially from one of these annuity charlatans at the free dinner steakhouse that ultimately just want to make a big commission on your retirement. Non-traded REITs, real estate investment trusts as they are called. These, again, are non-traded, meaning they're not liquid. These are sold usually through brokerage firms. I see this all the time. They used to call these things partnerships 15, 20 years ago, and now they call them non-traded REITs, real estate investment trusts. The problem with a lot of these REITs is when you get into these, you can't get out. You have no liquidity until they decide they want to sell, the general managing partner, let's say. The typical non-traded REIT will take off the top of your investment for underwriting fees and commissions about 18 to 20% of your actual money. So think about this. You put $50,000 into one of these non-traded real estate investment trusts through your broker who gives you a great sales pitch, and 20% off the top, $5,000, $10,000 off the top of your investment before your money even goes in. Not a good investment, and you lose liquidity. I try to educate investors all the time. Expenses do matter. Look at ETFs, exchange-traded funds. You can buy real estate through an ETF with an annual cost structure of 25 basis points or 1/4%. So why give up 20% of your money to the brokerage house or underwriting fees for these non-traded REITs? It's insane. Again, the investor needs to read the fine print because your broker buddy is not going to tell you the details, and he's certainly not going to point out how much of your money is taken off the top of your hard-earned money. The more money that goes to the brokerage firm and underwriting, the less money goes into your retirement and your pocket. You're the only one that cares about your money. You need to read the fine print. Alternative investments, things like hedge funds or commodity funds. These need to be avoided too. Let me tell you what, after the 2000 recession and after the 2008 recession, and most investors remember this well because your account might have been down 30 to 50% in value, brokerage firms came out with these hedge funds or these alternative funds or commodity funds, because what they told you is, hey, you need to be more diversified than just stocks and bonds. The problem is most of these hedge funds and commodity funds have done extremely poor in the last decade. And in fact, one of the reasons they've done so poor is the expenses internally yearly are sky high. So when I look at things like alternative funds and hedge funds and commodity funds that brokerage firms love to push, they're in that same bucket as non-traded REITs and annuities. Extremely complex, extremely high cost, and remember, investor, the only person that cares about your money is you. Your so-called advisor, your broker, or your annuity salesperson is not looking out for you. You need to read the fine print. If you're unable to understand some of these complexities, then you need to hire a fee-only fiduciary money manager. Little tip, no bank, no brokerage house, and no annuity salesperson is a fee-only fiduciary money manager. Let's go to Tom in Naples, Florida. What's an appropriate weight of stocks and fixed income securities at my age? Tom, I'm not sure your age, but an old rule of thumb, and not a rule that I would follow at all. Let's say you're 65 years of age. The rule of thumb was based upon your age, you should have that much in fixed income, and then the other portion in equity-based investments like the stock market. So if you're 65, you should have 65% in fixed income bonds, and the other 35% should be in equities or stocks. I do not believe in that. You need to look at the person's individual situation, how much income they need, longevity, retirement needs, taxation, risk profile, a number of different concerns. At that point, you need to look at how the economy is doing and where the value of these different assets are. Now, I will tell you this, bonds and stocks are not the only two asset categories that you should potentially look at, but unfortunately, most investors are sold stocks and bonds through their broker, so that's often the only thing they really understand or know. The problem with the fixed income portion that high at age 65, Tom, is if the 10-year Treasury, right now, the 10-year Treasury is paying around 2%, it's a little bit more, but let's round it to 2% for easy math. Can you survive making 2% on your money from age 65 to age 90 or 95? Probably not. If you are 65 years of age today and you are married, there is a 90% chance of one of you living into your 90s. You've got a 25 to 30-year retirement. 2% is not going to cut it. You need a higher growth potential and dividend stream. I talk about this all the time and I try to educate investors. You need a more dynamic investment approach that's adaptive. You need to look at total return, dividend, and growth of capital combination in order to have a chance to meet your retirement goals. But don't overload the boat in fixed income. You're taking way more risk than you realize. Larry from Fort Myers, Florida. I just inherited a chunk of money, but I know nothing about investing. What should I do? I think Larry, generally speaking, if you don't know anything about investing, and don't feel bad, one of the problems I think why a lot of investors don't really understand investing, it's not interesting to them, and also almost no school really teaches general principles of investing. I don't care if you're in high school or in college, they don't really teach what investors need to know. And if you know some of the basics, and it doesn't mean you're going to manage your own money, but if you know the basics, you'll keep yourself out of trouble from hiring somebody who's a salesman like a Wall Street firm, a banker, an insurance agent. So what I would tell you is this. Go to my website, ReznyWealth.com. You can sign up for instant email alerts, educational material my firm puts out all the time. This is unbiased information that is educational. We teach you what you need to know. Even if you don't want to manage your own money, but you want to be a little bit more informed, go to ReznyWealth.com. You can sign up for instant email alerts that come out once or twice a week. We also have a lot of articles in there and different various reports that explain investing and give you some of the baseline education you, the investor, needs so you can either make better decisions yourself or find a firm that can actually manage your money. You know, before I go to my next question, I want to point out one big flaw with most investors. They don't do their homework. And homework's important. Whether you're managing your own money or you're going to hire a firm to manage your money, do your homework. And what I mean by that is the firm that you're going to entrust your life savings to. Did you actually check out that firm? Did you know you can go to FINRA.org and check out your brokerage firm to see how many times they've been fined or censured for misdoings against their own clients? You can go to SEC.gov to check out registered investment advisors like my firm to make sure we're healthy, that we haven't done anything bad to our clients. You need to do some basic research. Most investors, if I have 100 people at a presentation that I'm putting on, and I ask for a show of hands, how many people have checked out their investment manager or their broker at FINRA.org or SEC.gov, I would say maybe 1 out of 100 people will raise their hand. Most people tell me, I never knew you could go there and check out my broker. So the bottom line is this, investors. You need to do some homework, even if you're not going to manage your own money. You need to go to FINRA.org or SEC.gov. If you want to know more information about checking out your broker to make sure he's working in your legal best interest, go to ReznyWealth.com, download for free our groundbreaking report, Your #1 Investment Risk, Fiduciary versus Suitability. Groundbreaking, educational. I guarantee if you read that report, you will be better armed to protect your net worth from Wall Street charlatans, banks, and annuity salespeople. I'm going to take a short break. I'll be right back with your questions after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, ReznyWealth.com, and download your free report right now. Hello, we're back. We've got, of course, we had a great show so far. The first half, we got more great information. The second half, we're going to take some of your questions and give you direct answers. You can send your questions to Brian Rezny at ReznyWealth.com. And make sure you do visit our website. Periodically throughout the year, I do various speaking engagements, workshops, educational, great for pre-retirees and retirees. Adapt for Success is the title of my workshops. If you'd like to meet me live, if you want to learn about protecting your retirement nest egg from the next recession, go to ReznyWealth.com, check out my workshops, times, availabilities, and to sign up. Annie from Cape Coral, Florida. What's the difference between dividend yield and yield to maturity and earnings yield? Annie, great question. Let me talk about dividend yield versus yield to maturity because I'm guessing you probably own a bunch of bonds. Let me tell you a mistake that investors make often. If you have ever bought a bond through a brokerage firm, you've probably made this big mistake. You were sold on what the actual coupon is of that bond. Let me explain. You call your broker, you say, I've got $50,000 to invest, and the broker shows you a bond that's paying 4.5%. That's the coupon. And you're thinking as an investor, wow, that sounds pretty darn good. It's better than what they're paying on CDs and in my cash account. I'll buy that bond. But what you fail to realize is you're actually not paying $50,000 for that bond. You're actually paying more because the bond is actually overvalued the $50,000. So you're paying more than $50,000. So even though the coupon says 4.5%, because you might have paid $54,000 for the bond, your yield to maturity might only be 1.2%, depending on what you actually paid for the bond itself. So remember, the coupon is not necessarily your rate of return. If you paid $50,000 for a $50,000 bond, yes, it would be. But if you did not, then your actual yield to maturity goes down. So at the end of the day, most people, when they buy bonds, do not buy a new issue bond. They usually buy bonds that have been in the marketplace for a couple years. So all of a sudden that bond's had a chance to trade around in different values. You then go in, you're sold the bond by the broker. Your broker is always going to tell you what the coupon is because they know that higher coupon, you're going to think that's what you're getting paid when you may be getting a much lower rate of return because you paid more for the bond than what the face value was. The other little hint I want to give you is this. Bonds are not just bought for the dividend. They're bought for total return. So maybe you bought a bond that was paying 4.5% and interest rates came down a little bit and now your $50,000 bond is worth $60,000. You could sell that bond and make a $10,000 gain. Now if you calculate yield to maturity from 60 to when it matures, or if you keep it till then, maybe your yield's only 1% a year. It might make sense to sell that bond before it matures, lock in a big capital gain, and redeploy that money somewhere else for a better yield to maturity level on the next round. Sam from Cape Coral, Florida. What percentage of my nest egg can I safely spend annually without running out of money? I'm 67. Sam, a lot of that depends on how you invest the money, but I'll give you a general rule of thumb. If you're 67 and you are married, there's about a 90% chance in that range that one of you will live into your 90s. So you've got a 25 to 30-year potential retirement. A long time, maybe longer than almost you've worked. General rule of thumb, at that age, if you're taking much more than 3% out of your portfolio each year, you're probably taking too much. If you start pushing 4 and 5%, unless your annual returns long-term are expected to make 8 to 10%, which is probably unrealistic, taking much more than 3 to 4% at age 67 is way too much money. The other thing you should do as a retiree, and I can tell you we do this with every one of our clients, is we do what's called a retirement capital projection. Look at the client's age, look at longevity, how long potential they can live, use realistic rates of return that the portfolio potentially could make on a projection, and then average that out over time. See what the client can really spend, show the client so you can make better decisions instead of shooting from the hip and running out of money or running low on money in your 80s. You don't want to make that mistake. You want to figure that out now. We do a great job at that at our firm. You can always call us for a consultation or visit our website, ReznyWealth.com. Linda from Cape Coral, Florida. What qualities should I look for in an advisor? Great question, Linda. At the end of the day, the only kind of firm you should ever hire to manage your money is a fee only, not fee-based. Remember, the brokerage firms and the banks are fee-based. They sell commission products, they sell some fee products. They're not fee-only fiduciaries all the time. They're salespeople, generally speaking. So if you want to find a real money management firm, only hire a fee-only fiduciary. Fiduciary acts in your legal best interest all the time, not some of the time, and actually manages your money. The best way to figure that out, if you go to my website, reznywealth.com, download for free your #1 investment risk report, Fiduciary versus Suitability. It's at the bottom of the homepage. It's a must-read, very educational, and it comes with a questionnaire. So if you are interviewing firms, you can go through the questionnaire and make sure the questions are answered correctly. That way you have a better shot of picking the right firm instead of a sales organization like Wall Street or the banks. And if you remember 2008, remember all the trouble people got into? They were typically working with a lot of these banks in Wall Street who created a lot of these crummy products that got a lot of us into trouble. Joe from Miami, Florida. Will gold's positive momentum stick? Joe, I'm not sure what chart you're looking at or performance, but gold has been in a negative downtrend for over 4 years. I would not touch gold at all. It's relatively weak on a performance basis. In fact, the way that we rank relative strength on asset classes at my firm, it's pretty much towards the bottom. So I would not buy gold. Gold typically does well for 2 reasons. Geopolitical events, which as you probably, if you haven't listened to the news lately, there's a lot of that going on, and gold's still going down at multi-year lows. And high inflation, which of course we do not have high inflation anywhere pretty much in the world, certainly not in the US, and gold's going down. So fundamentally, there's no reasons to buy gold. Technically, it's in a negative downtrend and relatively weak. I would not own gold, and I would be a net seller of gold on any strength there was possible. Ted from Naples, Florida. Will China's economy grow, or do you see a major problem ahead? Ted, there's been a lot of talk about China. If you remember, we had that maybe 8 to 10% correction back in August, September. And the reason for that mainly was China's economy slowing, or China's going out of business. I could tell you China is not going out of business. China's economy is slowing. They were growing their GDP north of 10% for a decade and a half. That is not sustainable for any economy, even China. They dropped their projections for GDP, gross domestic product, down around 6.5%. That's almost double to triple what the U.S. is currently growing at. That's pretty darn good. So I would expect China not to have a lot of problems. Volatility like any market. China's government is actually addressing this with stimulus. I see China's economy ultimately doing well long term, but if you're going to invest in China, you're a 3 to 5 year minimum investor. Expect volatility, but I do not think China's economy is going to bring down the world. In fact, long term, China's economy, because of their population growth and their change to consumer spending and things of that nature, will ultimately help the rest of the world. Brett from Fort Myers, Florida. Will 2016 be like 2000 or 2008? I highly doubt that, Brett. And the reason I say that is simple. 2000 happened because stocks were grossly overvalued. The S&P was trading at like a 35 PE ratio. Today it's trading at about a 16 PE ratio to next year's numbers. A lot of overvaluation. And we actually did go into a semi-recession because of 9/11, those terrorist attacks. 2008 really happened because all of the free money that people were buying houses and all this craziness going on, again, overvaluation in real estate. If I look at the general economy right now in the U.S., we're on a nice steady growth path up, growing about 2%. Real estate is not grossly overvalued, nothing like it was in 2005 and 6. The equity markets are not overvalued. We've got stable footing. We've got a very accommodative Fed that's watching things closely. I like what I see in the U.S. economy in 2016. It doesn't mean we're going to make 25% in 2016, but I think there's a good opportunity for positive returns, especially if the consumer stays on track, which the consumer in our country is doing better, and we've got these really low oil prices around 40 a barrel. That helps the consumer, every consumer, and it helps about 82 to 84% of businesses. Lower energy prices. I see a positive economy in 2016. Currently see no recession. We update our numbers daily. If something changes, I'll try and alert all of our TV and my radio listeners. But right now, I like what I see in 2016, and we at my firm are invested appropriately for a positive 2016. Steve from Bokeelia, Florida. Quantitative easing and the stock market. Will ending it hurt the markets? Not necessarily. Steve, at the end of the day, quantitative easing was put in play really to help stimulate the economy. Quantitative easing, for the most part, the government really has stopped their bond buying program well over 6 months ago. So it's already kind of ended and the economy's doing okay and the general equity markets are not doing bad either. So I don't see a problem with that. Where a potential problem could be, and again, I don't see a problem here, is if the Feds raise interest rates too fast. If they raise rates too fast, that slows down the economy too much. I can tell you Janet Yellen's give a lot of testimony about her stance on interest rates and the economy, and I feel pretty confident that the Fed realizes that they cannot raise rates too fast. I expect an interest rate increase, of course, in December and potentially another one in 2016. But the Fed is going to watch things. If things are not growing in the U.S. economy or they start to falter or slow down, the Fed, I feel, will be accommodative and they're going to do the right things. Great question, though. As always, folks, go to my website, ReznyWealth.com. Throughout the year, I do different various educational workshops. I call them Adapt for Success. If you're a retiree, a pre-retiree, you're not happy with the advice you're receiving, go to my website, ReznyWealth.com. Sign up for instant free email alerts about the economy and the investment markets. Learn a little bit. It goes a long way. And one of the things I want to leave you with is this. Look at your broker statement. Do you have the failed pie, the asset allocation pie your broker keeps pushing on you? It's failed. It hasn't worked. It's performed poorly the last 5, 6, 7 years. Remember, asset allocation is a recipe for owning everything instead of owning what's appropriate in a portfolio. It's a false sense of security. Remember to look at your brokerage statements. If you're not happy how your portfolio is performing, call my firm for a consultation. Schedule at one of our offices, either Naples or Fort Myers. Let's talk. Let's review. Make 2016 the best year ever, and make sure you secure your retirement for the future. Get real investment advice. Call my firm, and make sure you visit our website. And as always, don't buy investments that don't make sense for your portfolio, and never base any of your decisions on emotions. Have a safe and profitable week, and I'll see you next week.